Today, we're talking about directional biases. And if you want to stop getting crushed by the market, you absolutely need to watch this video. If you constantly feel like you're in a rigged casino, or no matter which direction you take, the market always does the opposite. If you feel like you're cursed because as soon as you buy, it drops, and as soon as you sell, it shoots up. The truth is it's not your fault. You're just suffering from an overdose of information. The result is that you're unable to define a clear direction. You're trading in a mental fog where all the information gets mixed up and tangled together. So yes, of course, you lose money. You pick the wrong direction, and you rack up losing trades. But there's something much deeper, and it's probably the root cause of all your problems. Deep down, you know it, even if you might not realize it yet. It's that feeling of being completely disconnected from the market, of never understanding its logic, of always feeling like you're one step behind. That nagging frustration of knowing there's something you're not grasping, but never being able to put your finger on it. And it's so frustrating that it affects your whole life. We've all been through this situation.
Good afternoon.
I'm Mercure, and I've been trading for over 5 years. I studied finance, developed my own strategies, and scaled up my own accounts, up to today where I work with a team of quants. That's why in this video, I'm going to reveal to you, step by step, my perfectly logical and mechanical plan that I systematically use to define my directional biases. Welcome everyone to this course where you'll finally understand how to avoid trading against the trend, how to avoid missing 90% of reversals, and how to avoid getting lost in all the vague information that doesn't make sense. As you've guessed, in this video, we're going to look at a clear bias strategy. And to do that, we need 3 specific concepts. First, we'll look at the external structure, then EPA versus IPA, and finally liquidity. But above all, we need clear rules. So make sure you watch until the end of this video. Subscribe to the YouTube channel, because in the next 2 minutes, you'll know exactly how to draw market structure. And if I'm talking so much about rules, it's because, in reality, you're currently trading in a subjective way. You know there's something you're not grasping, but you have absolutely no idea what it is. Look, for example, if I ask you what are the 2 or 3 confluences that allow you to define your bias, or what is the parameter that makes it 80-20 in defining your bias? If you're not able to answer these questions mechanically, then how do you justify risking your capital on convictions you can't even quantify? And to make this clear, we're going to see how to write objective rules in 5 steps. First, it has to be related to structure, candlesticks, liquidity, or timing, so that it's based on facts. Second, it has to work more than 70% of the time to be worth it. Third, it has to be clear and simple. Fourth, it has to be codable. And the 5th thing is that it should be written in just a few lines. It's exactly because right now, you're not applying these 5 points that you're stuck in a fog of information that's tangled and contradictory. Because your brain automatically fills in the gaps with cognitive biases, questions, and doubt. And it ends up looking more like this. What if I buy and it reverses? What if I sell and it shoots up? And what if this structure is just liquidity and not a breakout? What if you see everything, but you're just paralyzed by all the possibilities? You know how to set rules, so now we can move on to studying the first concept, which is external structure. So, the external structure is literally what will allow you to read your bullish and bearish trades. And it's by reading the structure that you understand how major trades are organized. So, based on the major trades, you can define your biases. Step number 1 now is to define the structure. And to do this, we're going to directly grab an indicator from Indicators, Community, and you type in Market Structure MTF. Then you click on this indicator and install it. It looks something like this. Step 1 is done. The structure is drawn. Now we'll see how to understand and interpret the structure. Number 2, we're going to learn how to spot 2 types of structures. So we have the external structure right here and the internal structure right here. The external structure lets you define your underlying trend, and the internal structure lets you take advantage of it. If today you don't have a major time frame that allows you to assess the price on a macro level, meaning the underlying trend, then it's normal that you keep getting wrecked on the internal moves. And what happens is that every time you buy, the price completely shoots off in the other direction, and every time you sell, the price surges upward. And little by little, this lack of understanding can lead to a lot of frustration. It can even go as far as lowering your self-esteem. Back then, I used to say that I was physically present, but emotionally absent. And to be honest with you, I got myself out of that with some simple and objective rules. So, simple rule. How do you determine your external time frame? Well, you take the time frame you're currently in and multiply it by 6 to get the external time frame. I'm on Euro USD. I multiply it by 6. And for my minor time frame, I just stay in the time frame I'm already in. So I stay on the 1-hour chart, and that's already my minor time frame. I'll show you a graphical example and you'll understand everything perfectly. Now, the rule now that we're on the charts. So here we are on the charts. We're on Euro USD 1 hour. The indicator is already properly installed and we're going to read the first rule. So, to define a major time frame, you simply multiply by 6 the time frame you're currently in. So, I'm on Euro USD 1 hour. I'll double click and multiply my time frame by 6. So, I'm going to click on time frame 2 in the indicator, activate the display, and set it to 6 hours. Then I click OK. You should normally see here, it will display 360. Very good. Now we defined our major time frame. For the minor time frame, what did we say? Well, we stay in the time frame we're currently in. We can now move on to step number 2. You have perfectly understood the rules for defining an external and an internal. Step number 2. We're going to see how to define your bias in an extremely clear way using the EPA and IPA rules. Up to now, you know exactly how to draw your major structure and your minor structure. And thanks to these rules, we'll be able to understand and break down in the rest of this video the trade that will just hit my TP at more than 20 RR on XOUSD. So make sure to stay until the end of the video to understand exactly how I took this trade and how you'll be able to do the same thanks to these rules. The question now is, how do you define a bullish bias and how do you define a bearish bias? Let's start with the bullish bias. We need to have a bullish break of structure, a return into the sell to buy, and a second bullish break of structure. This gives us a sell to buy that equals the retracement before the next break of structure. So I have a bullish break of structure, a return into the sell to buy. So in your previous sell to buy, the price comes back, which gives us a second bullish break of structure. At this precise moment, your bias has turned bullish, which means that little by little, your buyers are absorbing your sellers. So we'll be able to mark out a zone on all the upcoming sell to buy areas and play continuation reactions in the bias we've identified here as bullish. That means as soon as the price comes back here, we'll be looking to take buys, and we'll be able to do that until proven otherwise. And proof to the contrary would be either the IPA schematic here, or the IPA BCR schematic, or the EPA BCR schematic. In practice, what do we observe? Well, we see that there's a retracement here and we have a first structure break. The price comes back inside. So from this sell to buy the first time, and then it gives us a second break. From here, it comes back again into the sell to buy to give us a third break. And now? Well, now we're bullish and we can wait for reactions in this area to play bullish continuations. So that's exactly what we're going to see right here. Let's wait. We see that the price comes back perfectly into our sell to buy and gives us a bullish continuation. Okay? So here, you had a concrete example of a bullish EPA example. Quick stats update. On average, when you're in a bullish or bearish EPA, 70 to 80% of the time it's going to be a continuation. 20 to 30% of the time, it's going to be a reversal. There's nothing more you need to know. Stats update over. Now, as for the bearish EPA case, it's very simple. You should have understood by now. You observe a first structure break, so you draw your buy to sell. You wait for the price to come back inside. So the price comes back inside and gives you a second break. You are bearish upper. Example of a bearish EPA. We'll just take my last trade on XAU/USD. First thing, we see that we're on the 5-minute chart. So my main time frame is 6 times 5, 30 minutes, which is perfect. And we're going to start looking at our EPAs. So we have a break, a pullback, a second break, a second pullback. So from here, I could start looking for sells on my lower time frames. Second thing, we had another break here where you could have continued. You know your probabilities. And as we said, there's a 70% chance of continuation when we're in a bearish EPA, and a 30% chance that the price won't respect the EPA and will go in the opposite direction. By the way, guys, if you want the next part of the video about entries, comment next down below. Once we hit 100 comments, I'll start filming it. And by the way, don't forget to subscribe and give it a like. So, as you can see, it's great to know how to define a bias, but it's even better to know when not to trade and when not to look for a reaction. That happens when we're in an IPA state. In an IPA state, we don't trade. That means you have sell to buy moves coming back. Your price is efficient until the moment you get a sell to buy and the price simply doesn't come back to your zone. It will give you a second break, and this second break is considered IPA. So the price is inefficient and we no longer look for a reaction there. Let me restate the rules for you. So we wait for a bullish break. No return into the sell to buy just like here, then a second bullish break. Your market is now hyper. Exactly the same thing applies on the downside. So imagine being bearish for a while and you realize that at some point you get a bearish break and the price doesn't come back at all to retest its buy to sell before giving you a second bearish break. You are also in an IPA situation. So here in this example, we're going to have a very human case. For now, you can see that the indicator shows everything. We're in a bullish trend and we've been efficient 3 times in a row. Okay, you see a breakout and pullback, a second breakout and pullback, a third breakout. We've been efficient 3 times. So I'm going to draw my last sell to buy, where I normally expect reactions so I can keep trading. So we wait, and you'll see in this case that the price doesn't come back inside. That's why you need to have rules that are clear and simple, because otherwise your brain will fill in the gaps with questions like, but what if it does this? What if that liquidity comes in? What if this happens? What if that happens? And so you can see here that the price hasn't come back. So you do have a gap between your last sell to buy and your last structure point here. And what's great is that the indicator shows you this. You don't even need to think about it. Everything is marked for you. Everything is explained. Everything is simple. We can move on to the next part. Regarding the PIPA, we're going to check that the rules are objective. This will help you clear up the doubt and frustration you're feeling right now, because at the moment, your rules are probably unclear and subjective. which makes things a bit mentally foggy. So, are the rules related to the structure? Yes. Does it work 70% of the time? Yes. Is it clear and simple? I think so. Yes. Is it codable? As you saw earlier, it's already coded. And the last thing is it written in just a few lines? Yes. So, we can confirm that the IPA and EPA rules are objective. Number 3 and the last step. How do you track liquidity to have a 100% accurate bias? Don't worry, within the next minute, we'll do a chart example that sums up all the concepts. Well, it's extremely simple. So if you're bearish, we're going to wait for an EPA plus the recovery of a high. And if you're bullish, well, we're going to wait for an EPA plus the recovery of a low. Here are exactly the 2 types of liquidity we're going to look for. So let's get started with the chart example. We're still on euro to US dollar on the 1 hour, 6 hour time frame, efficient for 4 cycles, in a bullish trend. So if a low is taken out, in principle, we're good to have a liquidity grab. The low is taken out, so obviously, I've prepared the chart example for you. Here we have bullish liquidity, like this. And so, I should point out that from this moment on, you need to go to the lower time frame, see what's happening internally to be able to redefine your bias and or decide whether to take the continuation or not. Either you have confluence to buy, or you don't. And so there's a chance that price will make a move up and then drop back down the other way. That's what we call an edge. So, we can look at that in the next video. Like I said, comment on the video. And if you want to see the next part, just comment next and I'll prepare the following video. I'll show you a bearish example. And that way we can move on to the full recap. A bearish chart. Well, we can go back to the gold position. So here you can see that we had a bearish EPA with a liquidity grab, and we simply had a continuation. And all of this, we're doing with conviction and without any doubt. As you can see, we've just moved into IPA. So I wanted to point that out. And I'll just keep scrolling through. So yeah, that's what I do every day, over and over again. It works for me, but it also works for guys like John and plenty of other traders who follow the channel. The main thing is just to be mechanical, to have rules that are clear and objective, once again, and to stick to them, so we've got a liquidity grab. But on the other hand, you can see here that the trend, well, it didn't go anywhere because we didn't get any continuation. We were in IPA. We can see that the price is giving us a new breakout to the upside. So here, we've got a breakout to the downside and a breakout to the upside. If we get another breakout to the downside, which isn't impossible because looking at how the market is shaping up, I could try some sells. But that's a more advanced level. Again, if you want to see the more advanced level, just comment next, and like I said, once there are 100 comments, I'll start making the video. Well, like I was saying, we're switching to bearish, okay? So, it won't be shown on the indicator because it can't do that, but I can guarantee you that we've turned bearish now, so I could look for sells. And if I do it by eye, I could target sells above these highs, and between here, I could look for selling opportunities. So that's really something we're going to try to do. So here, perfect. Well, great. Right here, I could have tried to sell. And like I was saying, if you're mechanical about it, if you repeat the same pattern over and over again, it just becomes logical, and it even gets too easy. Well, I mean, too easy is a big word, but what I mean is, there are guys who joined the institute and it's starting to get easy for them because they're just mechanical about it and they repeat the same pattern over and over, probably backed up by data and just by sticking to a plan. What I can also tell you is that, well, I'll end this video by saying that we're reaching the culmination of a huge project with the whole team. We've been working on it for years and it's about quantitative trading. So it's everything related to AI, quantitative trading. And I can tell you it's really, really big because there aren't many people who can do this today. It's based on technologies that use deep reinforcement learning, and we have partners like NVIDIA, AWS, IBM, and Google. I'll keep you updated very soon, talk to you about it in the coming weeks and months, but you'll see, it's likely to be something exciting, something interesting, and honestly, I can't wait to tell you more about it. So here, you can see that we've got more of a liquidity grab, so we'd be looking to take continuations that are more bearish. So here, we've come back to grab, but since it came back as a wick, I'm still more inclined to look for sells. So, we're going to take the sells that were found right here. Okay, that's great. So, well, that seemed pretty logical to me. I'm going to keep scrolling through the market, so you can see the market is moving nicely. We'll do one last example, and then we'll wrap it up there. In any case, don't hesitate to subscribe and leave a comment. Anyway, if you liked the video and you like this kind of format, let me know and I'll make more for you. I'll do a part 2 at this level. I hope it's clear, concise, straightforward, and that there's no confusion. But anyway, for me it's a pleasure to share all this with you. Well, go ahead and apply it. And don't hesitate to send me little messages on Instagram to show me your progress. And we'll leave it at that. I'll try to see if we have another example. So here the indicator is bugging out. Okay, so here we have 2 bullish breakouts. So we're efficient. There's been a liquidity grab. So logically, we could buy. Let me check. Yeah, we could buy in those areas. I'm going to check to buy around there. Alright. So here, I don't have the internal info, but I can tell you that just by looking at the chart, by understanding what's happening internally, my ranges, I could target here. So let's see if I'm lucky or not. I would have been stopped out. But in terms of bias, well, we're perfectly good. Alright guys, that's the end of this video. Don't hesitate to subscribe, like, comment, and share. This was M. We'll see each other soon for the next video. And if you want to follow up, comment follow up. Bye bye.